Welcome to the deep dive. Today, we're really getting into something core to auditing.
Yeah, absolutely.
It's that critical link, between audit risk and the evidence auditors actually gather.
It underpins everything, really.
Yeah, because when you're looking at financial statements, risk feels like it's everywhere, doesn't it? We're talking audit risk, inherent risk, control risk. Getting a handle on how these shape our work is just essential.
Completely.
So our mission for this deep dive is pretty straightforward. We want to give you a really clear picture of how these different risks directly impact that evidence gathering process.
Making sense of it all.
Exactly. Whether you're working as an auditor, studying accounting, or maybe prepping for the CPA exam, this is fundamental stuff.
Crucial knowledge.
By the end, you should see exactly how auditors kind of strategically react to risk by changing up their evidence collection.
Turning uncertainty into assurance, in a way.
That's a good way to put it. Okay, before we dig in properly, just a quick reminder. This deep dive draws on material from Farhat lectures. All the content, the examples, everything we discuss, it comes from the comprehensive resources over at farhatlectures.com.
Great resources there.
Definitely. So if you're a student, CPA candidate, or already a professional, you should check out the website for more practice questions, video lectures, and detailed support. It really helps reinforce what we talk about today.
Absolutely.
And a big thanks to Professor Farhat for making this material available.
Hear, hear.
Okay, so let's start with something basic, almost common sense. Think about it. When you're facing a situation with higher stakes, more uncertainty, just more risk overall, what does your gut tell you to do?
Well, it's almost instinctive, isn't it?
Right.
When things feel riskier, you naturally want to check things more carefully, gather more information, be more certain.
Exactly.
And auditing is precisely the same. When we identify more risk, it's a clear signal. Okay, we need more evidence.
More work, basically.
More work, yes. And it's not just about quantity, it's quality too. We have to, intensify things, maybe bump up sample sizes, say, from 15 items to 25 or more, or perform much more in-depth testing.
Like digging deeper.
Exactly. It's kind of the auditor's way of dealing with anxiety, you could say. If we're feeling uncertain about something, the answer is more thorough evidence. That's our safety net.
So that fundamental connection, more risk, means more evidence. That's really the key takeaway we need to keep in mind as we go deeper.
It's the foundation for everything else we'll discuss.
Okay, so we get the basic idea. But how do auditors actually, measure or categorize this risk? How do they break it down to figure out how much more work is needed?
That's where the audit risk model comes in.
Yeah.
It's really the framework for thinking about this.
Or formula, right.
Yeah.
AR, X, CRX, DR.
That's the one. Audit risk equals inherent risk times control risk times detection risk. Understanding each piece is critical.
So let's unpack that. Start with audit risk, AR.
Okay, audit risk. This is actually the level of risk we, the auditors, are willing to accept that a material misstatement might slip through undetected, even after we've done all our work.
So it's our acceptable risk level.
Precisely. We set it. So if we set AR at, say, 5%, we're aiming for 95% confidence that our opinion is correct.
And if we want more confidence,
then we have to set AR lower, which means more work for us. It's our tolerance for potentially being wrong.
got it. What about inherent risk, IR?
Inherent risk, right. This is about how susceptible an account or transaction type is to misstatement before you even think about the company's controls.
So it's inherent to the business or the transaction itself?
Exactly. We assess it usually as low, medium, or high. Think about things like how complex the transactions are, how much judgment is involved, maybe how prone an area is to fraud. Some accounts are just naturally riskier than others.
Like a pre-existing condition for that account.
That's a good analogy, yes.
Okay, the control risk, CR. That sounds like it's about the company side of things.
It is. Control risk is the risk that the company's own internal controls, their processes, their checks and balances, will fail to prevent or even detect a material misstatement.
So if their controls are weak,
then our assessment of control risk will be high. We assess this too low, medium, high. Weak controls mean we simply can't rely on their system to catch errors.
which puts more pressure on us.
It does, and that leads us right into the last piece, detection risk, DR.
This is the one we control.
This is the one we control. Detection risk is the risk that our audit procedures, the tests we design and perform, will fail to detect a material misstatement that actually exists and wasn't caught by the client's controls.
So it's about our procedures potentially missing something.
Exactly. And we calculate it based on the other risks. Essentially, DR equals our acceptable audit risk divided by the combination of inherent risk and control risk.
So DR equals AR, IR x CR.
Correct. Or sometimes you hear IR times CR called the risk of material misstatement, or RMM. So DR equals AR RMM. It's the plug figure, really. It tells us how much risk we can afford to take in our own procedures.
Okay, that makes sense. So let's really connect each of these back to the evidence. Starting with acceptable audit risk, AR. You said we set this. What makes us set it low versus high?
Good question. A major factor is who's using the financial statements and how much they rely on them.
Like public versus private companies.
Exactly. For a public company, you've got countless investors, regulators, the public eye. The stakes are immense. Potential lawsuits are a big concern if you miss something material.
So AR has to be low.
Very low. You can't afford much risk of being wrong. But for a small private company, maybe only the owner and the bank see the statements. The reliance is lower. So you might be able to tolerate a slightly higher AR.
Are there other factors?
Oh, definitely. The client's industry matters. Think about a volatile sector like crypto versus a stable utility. Management integrity is huge. And ultimately, it comes down to the auditor's professional judgment based on all these things.
So here's the key connection. If we decide we need a lower acceptable audit risk, how does that translate to the evidence we need?
It's a direct inverse relationship. Lower acceptable risk means we need more evidence.
More assurance requires more proof.
Precisely. If you're only willing to accept a tiny chance of missing something, you need to gather a mountain of high-quality evidence to be confident. That public company under scrutiny. Rock bottom AR. That means incredibly detailed testing, maybe using advanced data analytics, pulling tons of documents.
Compared to the small private company where AR might be higher.
Right, the procedures can be less extensive, the evidence requirements potentially lower.
Okay, let's move to inherent risk, IR. The risk baked into the account itself. How does that influence evidence?
So remember, IR is high when transactions are complex, involve a lot of judgment, or are prone to error or fraud, all before controls.
Right.
If IR is assessed as high, it means there's a greater chance of misstatement just naturally occurring.
So we need to be more careful.
Exactly. Higher inherent risk means we have to set our acceptable detection risk lower. We can't afford for our procedures to miss errors when errors are more likely to exist in the first place.
And lower detection risk means?
More evidence. So higher inherent risk leads directly to needing more audit evidence.
Can you give an example?
Sure. Think about revenue recognition for a software company selling complex multi-year contracts with different service elements.
All right.
That's inherently risky, lots of judgment, potential for errors in timing.
Right.
So the auditor would need to do a lot more work. Examine contracts in detail, test assumptions, maybe even bring in specialists, gather lots of evidence to feel comfortable.
Makes sense. The messier the starting point, the more cleaning up or checking we need to do. What about control risk, CR? If the company's own controls are weak?
Well, if the client's controls are weak, we assess CR as high. And that means we simply cannot rely on their internal processes to prevent or catch mistakes.
So the burden falls on us again.
Entirely. Higher control risk forces us to do more substantive testing, direct tests of balances and transactions. We have to gather more evidence ourselves because we can't trust their system.
And this also means lower detection risk.
Yes. Because their controls aren't catching things, the risk that a misstatement exists and gets past controls is higher. Therefore, the risk that our procedures fail to catch it, DR, must be lower.
And lower DR means?
More evidence. It's consistent. High control risk equals more evidence needed from our substantive procedures. Think of a small business with poor segregation of duties for cash handling. That's high control risk.
So you do more cash counts, bank rec testing.
Exactly. Much more detailed testing of cash transactions because you can't rely on their controls over cash.
Okay, so this all comes together with detection risk, IR, the one we set based on the others. Let's just crystallize that final link.
Right. DR is our response. If IR and CR are high, the client is inherently risky and has weak controls. The overall risk of material misstatement, RMM, is high.
So we have to compensate.
We must compensate by setting our acceptable detection risk low. We cannot afford to take much risk that our procedures will miss something.
And the punchline, low DR means?
High amount of evidence, lots of work, rigorous testing.
And conversely?
Conversely, if IR and CR are low, maybe it's a stable industry, simple transactions, and the client has fantastic internal controls, then RMM is low.
We can relax a bit.
We can accept a higher detection risk. We don't need our procedures to be quite as stringent because the underlying risk is lower, and higher DR means
Less evidence needed.
Less evidence, less intensive testing. Maybe we rely more on analytical procedures or smaller sample sizes.
Okay, I think we've thoroughly dissected the model and the relationships. Now, let's make it really concrete. Can you walk us through those company examples you mentioned earlier? Show how this plays out.
Sure. Let's start with the local utility company. Stable, predictable business, straightforward revenue, probably strong, mature controls.
Okay, so risk assessment.
Acceptable audit risk could likely be set relatively high. Less external pressure, stable industry, inherent risk, low. Revenue is usually simple usage-based billing. Control risk, probably low too. These companies often have robust systems.
So low IR, low CR.
Means we can accept a high detection risk. And the result? Relatively low amount of evidence required. Not no evidence, but less intensive.
Makes sense. What about the nonprofit organization?
Right, nonprofits. Transactions might be simple, controls could be decent. So maybe low inherent risk, maybe low control risk.
But you mentioned a catch.
The catch is the reliance.
Yeah.
Donors, grantors, the public Bravel House, they rely heavily on those financials. That usually forces the auditor to set acceptable audit risk low.
So even with low IR and CR, the low AR changes things.
It does. Low AR combined with low IR and CR means detection risk probably needs to be set at a medium level. It's a judgment call, but you need more assurance than the utility required, meaning a medium amount of evidence. More work than the utility, driven purely by that external reliance demanding lower overall audit risk.
Interesting how AR can override the others. Okay, the big one, the cryptocurrency exchange.
Yeah, this one's almost the opposite extreme. Complex, new industry, volatile assets.
So IR is
Definitely high.
Yeah.
Very complex transactions, valuation issues, evolving regulations.
Controls.
Likely high control risk, too. It's a new field. Controls might be immature, not well tested, maybe even bypassed easily. Plus, the regulatory scrutiny and public interests are intense.
Which means ARR must be.
Rock bottom. Acceptable audit risk has to be very low. The consequences of getting it wrong are huge.
So low AR, high IR, high CR. What does that mean for DIR?
Detection risk must be set very low. We can afford almost zero risk of our procedures missing something material.
And the evidence needed.
High. Extensive, detailed, often specialized evidence. You're talking deep dives into blockchain transactions, cybersecurity controls, valuation models. It's a massive undertaking.
So it's not just about doing more of the same tests in high-risk situations.
Not at all. It's often about doing different tests. More experienced staff, maybe specialists.
Yeah.
Extending testing beyond year-end. Using more reliable external data. Multiple layers of review. It's a qualitatively different approach driven by that high risk.
That really paints a clear picture. Okay, time for a quick check-in with you, our listener, see if this is landing. Based on everything we've discussed, in which of these scenarios would an auditor likely collect the least amount of evidence? Is it A, a public company with strong internal control, B, a small private real estate company with minimal external reliance on financial statements,
Okay.
C, a nonprofit organization relying heavily on grants and donations,
Right.
or D, a pharmaceutical company with complex accounting estimates?
Okay. Think about the overall risk profile for each.
So what's the answer?
Well, let's look. A, public company. High reliance, low AR likely, so more evidence needed, even with good controls.
Yeah.
C, the nonprofit. Also high reliance, probably low AR, medium evidence perhaps. D, pharmaceutical with complex estimates. That screams high inherent risk, so definitely more evidence.
Which least
Option B, the small private real estate company with minimal external reliance. This generally presents the lowest overall risk. Likely higher acceptable audit risk, maybe lower inherent and control risk depending on specifics, but the key is minimal external reliance. That usually translates to the highest allowable detection risk and therefore the least amount of evidence needed compared to the others.
So B is our answer.
Correct.
Great. So wrapping this up, the big takeaway really is understanding those inverse relationships. How acceptable risk, inherent risk, and control risk all push and pull on detection risk and ultimately dictate the evidence we need.
It's fundamental to planning and performing an effective audit.
Yeah.
It's not just mechanical, it's constant judgment.
Absolutely. And maybe a final thought for you to ponder. Given this interplay of risk and evidence, where does professional judgment get tested the most? What's an area you might want to explore next? Maybe thinking about how auditors assess risk around, say, environmental liabilities, or perhaps how AI is changing the way we gather and evaluate evidence.
Lots to think about there. The field is always evolving.
It certainly is. And remember, if you want to solidify your understanding of audit risk or any other accounting topic, do check out farhatlectures.com.
Definitely worth a visit for more practice and explanation.
Professor Farhat's resources are incredibly helpful.
Agreed.
Well, that brings us to the end of this deep dive. Thanks so much for joining us.
Thanks, everyone.
Keep learning, stay curious, and we'll catch you on the next one.